Right, very good morning to you all, ladies and gentlemen. My name is Bruno, and I head up a company called Ironclad Asset Management. We manage alternative investments for multi-managers, advisors, and for DFMs. Our investment philosophy is that end investors are better off with a diversified portfolio of equities, bonds, and professionally managed alternatives. And it's really with the alternatives part that we try to add value. Just so that you have a reasonable place to put us in your mental model, we manage exclusively offshore investments, and within offshore investments, we focus on the long horizon of the risk spectrum. So our jobs with our suite of alternative strategies is to help you achieve your inflation plus 5, 6, 7 plus. So that's where we exist in the ecosystem of asset management. And typically when we engage a prospective client, we find them with a portfolio that looks a lot like this. 60% in global equities and 40% in global bonds. Our industry has dubbed this type of portfolio a so-called balanced fund, but I think most of us in this room know that at times it can be anything but, with 2022 being the most recent example of global equities and bonds falling in tandem in excess of 25%. And so it just takes a cursory look at history to understand that this is not a bug in financial markets, but very much a feature. Since 1900s, if we look at the US stock market as a proxy for risky asset performance, we find that for you to deliver inflation plus 6 or 7% in dollar terms, it's going to cost the occasional 50% plus drawdown. And as tough as those periods are to bear, I would argue that even tougher thing to bear is 10 years or more of sideways performance within the growth asset that you rely on to deliver on your long-term mandates. And so really as a business, we've got this challenge of investors rely almost exclusively these days on equities for their long-term growth. If equity disappoints, what do you have in your portfolio that can deliver? And as a business, that's really the problem statement that we're looking to solve. And you might say, well, that's what the 40% in bonds are for. But we would just argue that bonds have a more dilutive effect on the equity that you own, more than a diversification effect. And even if you were to argue that it is a reasonable diversifier, the reality is, if we look at long-term correlations between equities and bonds, they're starting to move more together than the recent history suggests. Final arrow in the quiver might be to try to time things. You might feel like we are on the 31st of December 1999, for those of you who remember or have studied the tech bubble. The reality is, as an advisor, you might feel, okay, let me get out of equity or reduce my equity position before it disappoints. And the risk that you take, of course, is that we're not sitting in 31 December 1999, but rather 31 December 1996. There's 3 years to go. Your competitors are still in their equity-heavy positions. Equities continue to run, and you, of course, look bad on a relative basis. And so ultimately, you're stuck and you try to diversify across managers. So ultimately, as a business, this is what we look to solve. It's that as equity investors and as advisors running equity-dominant portfolios, we rely on one asset class for growth. Ironclad as a business is built to add more. So just taking a pause in the room and just checking if everybody's with me so far in terms of maybe how we're trying to be different from everybody else in terms of adding something different rather than just being another equity or bond manager. Okay, so the way I'm going to structure this presentation is to just talk you through the architecture of the entire range of alternatives that we manage by category. We manage multiple different strategies in each category. I'm just going to go through one per, just to give you a high-level feeling. Please don't feel the need to take photos or anything like that. Go on our website. We give extensive information about each and every strategy. So 3 categories are, first and foremost, equity diversifiers, equity enhancers, and equity alternatives. So I'm going to go through each of these buckets one by one and tell you about our flagship for each of these. Starting with our equity diversifiers. If you go to ChatGPT and you were to type into your ChatGPT, tell me about a strategy that is uncorrelated with equity most of the time, but helps when equity is down badly. I'd venture a guess to say that your ChatGPT will say what mine does, which is that trend following is a strategy that you need to consider. Trend following is a cousin of momentum, which some of you might be familiar with. You go long rising markets, short falling markets, and you profit from a continuation in those trends. But instead of the classic momentum where you're doing it at the single stock level, Naspers has been going up, you're long Naspers has been going down, you're underweight Naspers. You do this on global futures on the big four asset classes: global equities, global bonds, commodities, and currencies. So you might look at a portfolio that's long UK stock market, short the Japanese yen versus the dollar, long copper, and short, for argument's sake, the US 10-year as an example. So it's a very diversified mix of assets, but it makes money in the same way as momentum does. Prices continuing to rise and you participate, prices continuing to fall and you participate as well. And it's that latter part that makes the strategy really interesting for an equity portfolio. It's that making money when markets are going down. So if I point you to the screen, why should you care? The red line is the performance of our trend following indexes, most well-known and most well-used peer group average performance. It's the Soc Gen Société Générale, the French bank trend index. They measure the performance of the top 10 trend managers at any given point in time, and this has been the track record through history. A couple things to note that are of interest. Firstly, the line goes upwards and to the right, maybe not as high as equity does in dark blue, but there and thereabouts. So standalone, absolute performance, which is attractive, tick. Secondly, quarterly and monthly returns are uncorrelated with both global equities and global bonds. So if you're looking for a diversifier, I would argue that that is sort of exactly what you're looking for, is something that is uncorrelated with the stuff that you already own. And thirdly, and most, I think, attractively, is if you have a look at the shaded areas, which measure the performance of equity during the very bad drawdowns since 2000. Dot-com bubble early on, 2008 global financial crisis, then into COVID in 2020, and finally in 2022, what you find is that on average, trend delivers positive returns in the worst times for equity. Why? It gets short the markets that are falling, that continue to fall, and therefore you continue to profit from that outcome. So a good solution, in our opinion, in standalone terms, and in our opinion, the single best diversifier to a stock and bond portfolio that exists. And just like momentum, lots of very small losers, a few very big winners is how this strategy works. So for example, last year, our biggest two contributors to our profits were gold and silver. We got long gold and silver towards the beginning of 2025, not because of any fundamental reasons. We are a purely systematic manager. We just follow the price trends. So we got long gold and silver towards the beginning of 2025. We rode silver's rise of 300%, by the way, all the way to its top. And then when silver reversed, ultimately we exited the position, having taken a spectacular profit. So gold and silver were responsible for about 40% of our P&L within our trend portfolio last year. The reason we started doing trend following was in 2022, we managed a risk parity portfolio, which is quite heavy in stocks and bonds. They fell precipitously together. It was a very ugly time to have been a balanced investor. And we looked around and said, what strategies are doing well in these torrid times? And we noticed that trend following as a category was up more than 30% at a time that equities and bonds were down more than 25%. So we said, listen, we have to figure out how to do this and let's get going. Let's build a strategy around this. We got going in August of 2023, so it's almost been 3 years. The red line is our actual track record net of fees in US dollars. And over this period, we've delivered 7.8% annualized versus the benchmark at 3.8. And what we're really proud of is the monthly correlation at 83%. So this is a trend following portfolio. And what we're really proud of is you no longer need to call London or New York to get this. You can call us in Joburg. Does it work when you mix it with a balanced portfolio? So in the red line, I show 80% balanced with 20% trend, and the blue line, 100% imbalanced. What you see is that it can potentially add value on the return line, and the value that it adds on the return line stems primarily from losing less when markets draw down. So you compound better. You lose less, reinvest in the subsequent recovery, and your compounding works better over time. The existing clients who make use of the strategy do so for three primary reasons. The first one is as a pure portfolio diversifier. They've got equity managers, they've got bond managers. This is a third leg which helps with diversification. The second is for crisis alpha. There are those who take the tactical view that we are closer to December of 1999 than we are to December of 1996. And what worked well in the dot-com bubble, if you draw analogies to where we are now with AI, is trend following, at least when that bubble burst, because you got short the markets that were falling. So that is one tactical reason that people consider trend. And finally, it's really as an inflation hedge. A key driver of returns for a trend portfolio is commodities. So you get long the commodities that are rising. Often it's those commodities rising that cause the inflation to begin with. And we know that stocks and bonds hate inflation, and therefore this is a really good offset potentially against that. So that's our diversifier hero, our flagship. But some clients might say to us, listen, that's all good and well, but I'm an equity investor or I've got an equity mandate. What can you guys do for me? And so the way we look to affect an equity portfolio primarily is to mix it with trend. Trend is a good thing for stocks and bonds that you hold elsewhere, so it must be a good thing to mix with the equity that we manage as well. But trend has one key weakness, and that is that when markets fall over days and weeks, meaning very quickly, you're at the mercy of how your trend portfolio was positioned before that big drop. So if you're long equities in your trend position, it takes time to adjust that positioning. So you might experience the drop with equity. If you were short equities, of course, it's going to be an excellent hedge in that time. We don't want to be at the mercy of how trend was positioned for COVID-type crashes. So all we do is we add a strategy which works, which is tail hedging. Tail hedging is using options. It's basically like insurance for your portfolio. I'm not going to get into the specifics. If you want to get into the specifics, please come find me at lunch or afterwards and we can talk options together. But if I can just highlight what we're trying to achieve out of that sleeve, it's large payoffs in black swan events where we take those payoffs and reinvest it into the underlying equity in anticipation of the subsequent recovery. So I hope you're hearing the themes over and over again. Participate, fall less when markets fall hard, have that liquidity to reinvest in risky assets in anticipation of the subsequent recovery. That's the ethos of what we bring as a business. Our answer to our equity enhancement range is really using portable alpha. Some of you might have heard of it. Simple solution is client has $100 in an equity ETF, an ACWI ETF for argument's sake. You give us that same $100, we reinvest it into the same ACWI mix, just using futures contracts, and then we use that cash collateral to then stack our trend following and our tail hedging alternatives on top. So you keep your equity and you just stack the diversifiers on top. This is in contrast to selling out of your equity and including those diversifiers in. So a little bit of a different way to think about it, but it helps you keep your equity and add diversification in, as opposed to selling out of your equity and introducing diversification in. This is the long-term backtest. Did my PhD on exactly this subject matter. What you find is a really attractive equity-like payoff profile over time with some alpha. And the reason, once more, for that alpha is falling less when markets fall hard, except you're not only reliant on one leg, which is trend, to do that. You've got something for when markets fall fast, which is your tail hedging, something for when markets fall slow, which is your trend following. This is how we've done since we started with a Fortress portfolio. It's been almost 3 years to the day. We're up 19.2 annualized versus ACWI at 20.1. So again, we're there and thereabouts on equity participation, and I would just argue that this type of portfolio looks, in our opinion, very good prospectively, because we've demonstrated that if equity runs hard, and we are in December of 1996, and there's 3 years left for equity to run, you can broadly participate. But if we are in 1999 and AI is going to turn and we see those large drops, you've got the trend following and the tail hedge mechanism in place for defense. So you've kind of got both angles at least somewhat covered. The reason people include Fortress into their portfolio are threefold. Firstly, they just consider us another active manager, just like any other. You would have heard many presentations from many active managers in South Africa. We're spoiled for choice for stock picking. This is just a very different approach to try to achieve the same objective, which is outperforming a passive benchmark. We just do it quantitatively, systematically, in a very different way to diversify your mix. Secondly, you've got a passive ETF just sitting there. We're just going to reinvest the capital that you provide us into a passive mix and stack the alternatives on top. And finally, if you, by mandate or by choice, don't want to get rid of any equity exposure, we just give you the power to maintain or retain what you've got, introduce the alternatives on top. Finally, I'd like to introduce you to our alternative range. So right at the beginning of the presentation, we discussed this idea that the problem with equity is not that it delivers cash plus 7, or rather inflation plus 7. It's really the times where you look back 5, 6, 7 years and equity has gone sideways or down. And that is what our equity alternatives are really built to solve. The objective is to put score on the board. So this is a quite aggressive strategy, and it's got a singular focus, which is to be the second growth engine in your portfolio. This is what it looks like. I'm not going to focus too much on its construct, but basically it allocates to assets that harvest risk premia. In other words, just a balanced allocation to multi-assets that participates in just the general balance sheet of the world going up. And then secondly, it also stacks our favorite trend following strategy together with some other seasonal approaches to try to harvest returns when markets are going sideways or even down. Backtest looks like this. It is an aggressive portfolio, so that is our backtest in dollar net of returns. And being a fairly aggressive portfolio, it does mean that on occasion, you will draw down fairly significantly. So drawdowns are quite frequent in the 10% range because of the amount of gross exposure, but it rarely goes beyond 20. And the reason for that is, firstly, the sub-strategies that make up the multi-strat are quite uncorrelated with one another, but they've also got explicit risk management built in. So strategy starts to take pain, you reduce your exposure until signals improve and you're willing to put risk on again. So it's got proper built-in risk management as well. This strategy has only been up for a year, but it's been a really powerful year for us. So we're up about 42% since inception. I think equity was up around 30% over the same time, and cash plus 6 at 10. Yeah, and just another bit of emphasis as to why you would consider this in your mix is that sometimes over a rolling 5-year period, equity doesn't look good. You do get negative 5-year periods for equity and low single-digit returns. And what we hope that we've got on our hands here is a multi-strat that can deliver independent of equity. So I hope the themes are coming through. You've got enough equity in your portfolio. What do you have if equity doesn't deliver? And that's really how we've tried to organize the business. Single reason people use this, and that's as a second growth engine within their portfolio. So this was going to be the end of my presentation, but we got some really spectacular news on Tuesday, and we are the very first offshore AMC to be approved by one of the big 4 trustees, collective investment scheme trustees in South Africa, for allocation to one of our offshore AMCs. So a South African fund can now buy one of our products directly into it. It's no longer just the suite of solutions that is purchased off a stockbroking platform. And that strategy is our single strategy that we run that's non-hedge fund in nature. It's long only unleveraged, and it can form part of your 10% allowable commodities allocation within a Reg 28 fund. And that strategy is called our Enhanced Commodity Strategy. It is, as I said, the very first offshore AMC to be approved for investment by a South African collective investment scheme. And the reason you should care is that commodities as a whole, we know, are a really attractive inflation hedge solution. And for that reason, are worthy of considering, because if you've got equities and bonds, both equities and bonds hate rising inflation. Having something in place that can diversify in those times is very valuable. The trouble is that existing commodity solutions, excuse my French, are terrible. And the reason for that, we think, is a complete overconcentration in oil. So broad commodity indices, which shall remain nameless, tend to allocate on a production-weighted basis as opposed to be allocated in a sensible investment, for a sensible investment case, we think. And so you end up with a commodity ETF that is very heavy in oil, which would have been an excellent investment over the last year. But all you need to do is to zoom out and look at what that performance would have been like since 2008. And you would have had a 90% drawdown before this spectacular year that came around. So of course, we built a solution that solves for this. We start with the 6 big commodity sectors. And those are livestock, industrial metals, precious metals, energies, grains, and softs. There's multiple different commodities underlying each of those sectors. So for livestock, you've got lean hogs and live cattle and feeder cattle. For industrial metals, those are your coppers, your aluminiums. For precious metals, gold and silver. Energy is your crude oil and Brent crude oil and natural gas, all the different diesels, heating oils, that kind of stuff. Grains, wheat, soybean meal, that kind of thing, and then soft cocoa, sugar. So stuff that we interact with and that we know every single day, that when they go up in prices causes the inflation that damages our equities and our bonds. And so what we've done is made a long-only solution investable by normal South Africans in dollars. So not only do you get the inflation hedge, you also get the rand dollar hedge embedded within it. And it looks tremendously different from traditional index commodities. So if you look at an ETF today, it will have in excess of 50% in oil. So investing in one of those ETFs is tantamount to investing in oil. And so what we've tried to do is make broad commodities properly investable, where lean hogs has as much contribution to your P&L as does crude oil. And therefore, just give you something that's a heck of a lot more smooth and tries to fully harvest the best of the low correlations between commodities. So heating oil and crude oil move a lot like each other, as is sensible, but what does live cattle have to do with the price of copper? These two things are very lowly related in a portfolio. So when you're constructing a portfolio, these lowly correlated assets are really beautiful to combine together into a portfolio mix. And if you run that portfolio over time, the one that we do, we get the red line, that's the back test. It's only been live for a couple months. We have another commodity strategy that's been up for 2.5 years, in excess of 20% up year to date. And again, that strategy tries to solve for a very similar thing that we've got over here, which is commodities are a good thing. You don't have to exclusively invest in oil. And that's really the problem we're trying to solve. So our strategy runs at, roughly speaking, 10% volatility, and that's targeted over time. It does lead into some trends. We are trend followers at heart, so we do overweight the commodities that are rising and underweight the commodities that are falling a little bit. And ultimately, that just tries to achieve a little bit of alpha in an otherwise very broadly diversified commodity mix. I thank you for your time and welcome any questions.